Will the housing market crash in 2024? That's a question that has been on many minds lately. Welcome to our deep dive into the complex world of the housing market. As we navigate through this year, 2024, it's more relevant than ever to understand the factors that could lead to a potential crash. These factors include, but are not limited to, low inflation, low unemployment, and the possibility of a recession. High mortgage rates could be a cause for concern, and let's not forget about the issue of low housing affordability, which is increasingly becoming a challenge for many. Each of these elements plays a unique role in the stability of the housing market, and it's the interplay of these factors that could spell prosperity or disaster. So stay tuned as we delve into the possibilities of a housing market crash in 2024. Imagine a scenario where inflation is low. How does this impact the housing market? Well, let's delve into this fascinating topic. Inflation is a term that refers to the general increase in prices over time, or in other words, the decrease in purchasing power of your hard-earned money. When inflation is low, it means that the prices of goods and services are not rising significantly. Now you might be thinking, that sounds great, who doesn't love stable prices? But when it comes to the housing market, low inflation can actually have some unexpected effects. Consider this, when inflation is low, interest rates also tend to be low. This is because central banks, like the Federal Reserve in the United States, lower interest rates to stimulate spending and investment, which can help to increase inflation. These low interest rates make it more affordable for people to borrow money, so they might be more likely to take out a mortgage and buy a house. This increased demand can drive up house prices. Now let's imagine a hypothetical situation. Let's say that inflation continues to remain low for an extended period of time. The central bank keeps interest rates low to try to stimulate inflation. More and more people take out mortgages to buy houses, and house prices continue to rise. However, wage growth tends to be slow in a low inflation environment. So, even though more people are buying houses, they might not actually be able to afford these houses in the long run, especially if their wages are not keeping up with the rising house prices. This could lead to a situation where many homeowners are unable to pay their mortgages and they may be forced to sell their houses. This sudden increase in supply, coupled with a decrease in demand as fewer people are able to afford houses, could cause house prices to plummet, potentially leading to a housing market crash. Therefore, low inflation can be a significant factor in a possible housing market crash. Now consider a situation where unemployment is low, but mortgage rates are high. What could be the repercussions? Picture this. A thriving economy with low unemployment rates. More people are earning, which naturally leads to an increase in the demand for housing. People want to invest in homes, and why wouldn't they? After all, a house is not just a roof over your head, it's also an asset, a symbol of stability and financial security. However, here's where the plot thickens. Alongside this low unemployment scenario, let's add another ingredient into the mix: high mortgage rates. As mortgage rates climb, the cost of borrowing to buy a house also rises. This means that even though more people have jobs and the demand for housing is high, the cost of owning a home becomes increasingly unattainable for many. So how does this play out? Well, even as demand for housing remains high, high mortgage rates can push potential buyers out of the market. Those who were once eager to become homeowners may now find themselves unable to afford the steep costs. As a result, houses can start to sit on the market for longer periods, and sellers may be forced to lower their prices in an attempt to attract buyers. This can trigger a domino effect. As prices fall, homeowners may find that their homes are worth less than what they owe on their mortgages, leading to a rise in defaults. This in turn can cause banks to tighten their lending standards even further, making it even more difficult for people to buy homes. Before you know it, the housing market could be in a downward spiral, teetering on the edge of a crash. As you can see, low unemployment coupled with high mortgage rates can be a recipe for disaster in the housing market. It's a delicate balance, isn't it? Just another reminder of the intricate web of factors that influence the health and stability of our economy. What happens to the housing market in a recession? And how does housing affordability play into this? Well, let's dive in and unravel this mystery. When a recession hits, it's like a domino effect. One of the areas that feel the impact is the housing market. The economy slows down, people start losing their jobs, and suddenly fewer folks are out there looking to buy houses. This decrease in demand can potentially lead to a housing market crash. Now imagine you're a homeowner already struggling to keep up with your mortgage payments. A recession could mean lesser income, making it even more challenging to hold onto your home. And for potential home buyers, the high price tags on homes might be an insurmountable barrier, particularly if their income has taken a hit. But here's where housing affordability comes into play. Housing affordability is a measure of how easily an average family can afford to buy a house. The lower the affordability, the harder it is for families to buy homes. And in a recession, affordability usually takes a nosedive. Why is that? Well, in a recession, wages often stagnate or even decrease, but house prices don't necessarily follow suit. And if you add high mortgage rates into the mix, you have a recipe for a housing market that's out of reach for many. So, what's the upshot of all this? A recession can turn the housing market on its head. It can lead to a decrease in demand for houses as people struggle to afford them. This, in turn, can lead to a potential market crash. But remember, every recession is different and the housing market's response can vary. It's like a game of Jenga. If you pull out the wrong piece, in this case, a recession combined with low housing affordability, the whole tower can come toppling down. But just like Jenga, the game isn't over. It's just time to reset, rebuild, and start again. So, a recession and low housing affordability can indeed be triggers for a housing market crash. So, with all these factors at play, will the housing market crash in 2024? Let's quickly recap what we've covered so far. We delved into the concept of low inflation, a scenario where the prices of goods and services rise slowly, if at all. While low inflation can be a sign of a healthy economy, it may also indicate sluggish economic growth. In the context of the housing market, it could lead to slower appreciation of home values, making homeownership a less lucrative investment. Next, we touched upon low unemployment. A low unemployment rate signifies that more people have jobs, and therefore potentially the means to buy homes. However, in an ironic twist, this could lead to higher mortgage rates, as lenders anticipate greater demand for loans and adjust their rates accordingly. High mortgage rates in turn can deter potential home buyers, putting a damper on the housing market. Then, we took a detour into the realm of recession. A recession, a period of temporary economic decline, can have a profound impact on the housing market. It can drive down home prices and increase the number of foreclosures as people struggle to meet their mortgage payments. We also explored the issue of low housing affordability, a situation where a significant proportion of the population can't afford to buy homes. This could be due to high home prices, low wages, or a combination of both. Low housing affordability can lead to a slowdown in the housing market, as fewer people are able to participate in it. So, with all these factors at play, will the housing market crash in 2024? It's a complex question with no easy answer. These factors all interact in intricate ways, and their collective impact on the housing market is hard to predict. It's also worth noting that other factors, not discussed here, could also influence the housing market. While we can't predict the future with certainty, understanding these factors can help us prepare for potential outcomes in the housing market. So, will the housing market crash in 2024? Only time will tell.